Hello, everyone, and welcome to today's Vistage webinar. Before we begin, I'd like to go over some housekeeping items. As an attendee, you are in a listen and view only mode with no ability to unmute or start your cameras. You will be able to type your questions by selecting the Q&A icon on your Zoom toolbar. And with that, I'd like to turn it over to our moderator for today's webinar, Joe Galvin. Please go ahead, Joe.
Welcome, everyone. I'm Joe Galvin, Chief Research Officer for Vistage. I'm happy to host the latest in our Peak Performer webinar series. This series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community who provide exceptional insights and best practices to help you navigate new challenges and possibilities. Today, we're going to talk about the economy. Capital markets are wrestling with the potential implications of higher inflation and corporate and personal taxes, which will significantly influence the economic outlook over the next 12 to 18 months. We've invited our good friend, Dr. Adrian Cronje, back. He's the CEO and CIO of Balentine. Back with us to discuss what the stock, bond, credit, and commodity markets are currently signaling about the future of the economic environment. We had Adrian with us a year ago, last April, when we were all trying to grasp the initial free fall of the pandemic. And then again in late July for an update. We thought it'd be a great time to bring him back, hear from him again, and get his thoughts as we move through and beyond the recovery and into the post-pandemic new reality. Adrian's been a member of Vistage for over a decade and was recognized as the top new Vistage speaker in 2019. Adrian, welcome. We are so glad to have you here. I am so anxious to hear what you say, and we look forward to your thoughts and presentation.
Joe, thank you very much, and good afternoon, everybody. I am delighted to be back here again, and as you say, it was July of last year when you and I last caught up, and what a difference 9 months make. In fact, in preparation for today's webinar, I took some time to read through the most recent Vistage CEO Confidence Index, and you titled it Record Gain in CEO Confidence Driven by Vaccines and Federal Spending. And as I looked at the chart, it almost traced out a perfect V-shaped recovery in CEO confidence. And I remember talking to you back in July last year about what the trajectory of the recovery was likely to be. And I told you at that time that despite the disconnect, the apparent disconnect between an economy in deep recession and ebullient capital markets, that perhaps we need to be more optimistic than the headlines at the time suggested. Indeed, I remember saying, I think the big risk as the pandemic unfolded was being too negative about the outlook. And hopefully those capital market signals and the forecasts we talked about at that time avoided you all from becoming too negative. And so it is hard to believe just how much has changed over the last 9 months. Let me start by setting our agenda today. First of all, I wanted to bring you all up to date with what the capital markets are signaling today. We're going to talk, as Joe said at the outset, about the stock market, the bond market, the credit market, and the commodity market, and having a look under the hood as to how they've evolved since July of last year. I want to then spend some time talking about some key themes that the pandemic accelerated. These themes were in place before coronavirus set the economy into lockdown, but have become a permanent part of our life and are set to influence a post-pandemic environment permanently. And then I want to end off before opening it up to questions from you all with 2 little projects that I completed during the pandemic. One is what I refer to as the Balentine Investing Cardinals. And that has been in response to a number of you all calling me saying, I enjoyed your talk about the capital markets and the economy, but how should I invest my money? And my answer to that question is the same as always. I don't know, because I don't know your context. So what I did during lockdown was to spend a little bit of time authoring what I call the Balentine Invest Cardinals, some enduring principles that might help you, guide you as you think about your investments outside of your business. These have been very well received, and you'll be able to register to receive those on our website. And by the way, as I talk this afternoon, I'll be mentioning several resources for you all to read around or to double click on some of the issues that I've raised. And those will be available free of charge on our website, where we've created a page dedicated to Vistage members. So Balentine/Vistage, you'll be able to download any of the resources that are referred to along the way, and hopefully that'll be helpful to you. My second project was to complete a book that I had authored with my partner and chairman, Robert Balentine, who's been a Vistage member for nearly 3 decades now. And we talk a lot about first-generation wealth and some of the challenges that entrepreneurs and businesses face as they transition from their business to life after business. And I think around the major topic today about the economy and what that means for your businesses, those 2 resources might be helpful to you. So let's get started. I love this cartoon. I feel like this captures what the zeitgeist was like in the summer of last year. It felt like a bad horror movie that we simply couldn't leave. First, there was the unforeseen pandemic. Then there was a mini depression in the second quarter. That was followed by social unrest, only to turn our attention to certainly the most poisonous and contentious election cycle in my career. And of course, everybody was so focused on whether we'd be able to find a medical solution to the medical problem, which was really at the heart of the reason to lock down. It is hard to believe today, to get to the bottom line, that over the next 3 months, we are likely to experience the most robust period of economic growth that our country has enjoyed since 1983. And you would have to go back to 1957 prior to 1983 to see such strong underlying economic growth. And so that should not be a surprise to this audience, because as I said to you back in July, that's what capital market indicators were signaling at the time. Despite this bad horror movie that the media was reporting, the stock, bond, credit, and commodity markets were looking through the abyss and were actually anticipating correctly that a medical solution would arrive more quickly than people were concerned about at the time, and that the economy would open up again, and that the economy would recover its previous highs set in 2019, perhaps more quickly than people anticipated. And a reminder of the logic and the power of my approach is to remind you all that deep down, what really causes cycles and economic activity to occur is because each and every day, thousands of investors in the stock, bond, credit, and commodity markets are looking 12 to 18 months ahead at what the future might bring. And investors very rarely cycle from euphoria to despondency and back again overnight, although it has felt that way during 2020, during an unforeseen pandemic. But this tried and tested observation that cycles of investor psychology is what drives economic cycles is key to understanding why these capital market indicators are so powerful and so reliable over a time frame that is useful for us as business owners in order to make changes to our strategy so that we can pivot our businesses to take advantage of others' distress during trying times, rather than just thinking about downturns as a risk mitigation exercise. As I've often said before, what I've learned from studying economics all the way through to the PhD level is that economists understand how the economy works very, very well. Unfortunately, traditional economic forecasting is very unreliable on a 12 to 18 month time frame. In fact, if you look at the track record of professional economists and strategists at forecasting the economic environment a year hence, it's pretty lousy. It's a little bit like driving the car down the road by looking in the rear view mirror. Instead, use forward-looking indicators that are given to you each and every day by the capital markets. And here I will refer you to the resource that we've made available on our website that explains everything I'm going to describe at a high level in greater detail. It's called Are Recessions Red Lights Flashing? And it's the subject of my core talk, which I've enjoyed giving to many Vistage groups across the country. So let's get into it. Here are those indicators. And let's start by where we've come from. And here on that table, I'm showing you how these key indicators, the stock, bond, credit, and commodity markets have evolved. It's hard to think about what we were wrestling with in the first quarter of 2019. But let me take you back to that time. Remember, all the talk at that time was about the escalating tariff war as we really got to terms with our strategic relationship in China. And we were also worried that at that time, the Federal Reserve was raising interest rates too quickly, given the underlying economic recovery. And many traditional economic forecasters were actually forecasting a recession for 2019. As these indicators showed you in the first quarter of 2019, the outlook was not strong across the board, but it would at least was fair to strong. And so my message at that time was, again, don't get too faked out about some of the negativity in 2019 that so many prognosticators were suggesting was going to be the case. Of course, fast forward a year later, and those recession red lights were flashing across the board in a 3-week period in March, as the really unforeseen event was perhaps not the pandemic. After all, we had a pandemic 100 years ago with the Spanish flu. The really unforeseen part of last year was the decision to put the economy into lockdown to ensure that the pandemic did not overwhelm the healthcare system. And what has been key, and as I mentioned in July last year when I last had the opportunity to talk with Joe, is just how quickly those indicators have moved from dark red through yellow to dark green today. And I'll walk you through what those indicators look like. But before I do so, I want to remind you of what the key link is in each of these indicators about the future economic environment. Let's start with the stock market. So the stock market obviously is probably the most followed market by all of us. After all, you can't get into an elevator or watch a newscast without the 3 tickers of the S&P 500 and the Dow Jones and the NASDAQ scrolling underneath. But remember, what's so powerful about the stock market is that investors are looking 12 to 18 months hence and even beyond to measure what the profitability of stocks are today and what they are likely to be in the future. There has never been a recession in our country without corporate profits being in a recession. Unfortunately, the stock market is not a fail-safe indicator. As Paul Samuelson, the Nobel laureate, famous quip, be careful of the stock market. It's a powerful indicator of the future, but it has forecast 9 of the last 7 recessions. In other words, there have been instances of a corporate profits recession without an economic recession ensuing. And so it's not a fail-safe indicator and should be used in conjunction with what the bond market, the credit market, and the commodity markets are telling us today. And so we'll talk a little bit more about how the stock market is assessing the future in a moment or two, and in particular, the 2 major issues confronting capital markets today, which is question number 1, is the economy actually going to grow so strongly over the next 12 to 18 months that there will be incipient inflation, the likes of which we have not seen for several generations? And question number 2, as Joe said at the outset, what is the outlook for taxes? Right at the moment in Washington, D.C., they are starting to firm up their proposals as to what taxes are likely to be next year. And that is obviously a key question for all these indicators about the outlook. The next indicator is the bond market. And for those of you who have heard me speak about this before, this is a particularly important indicator for you as a business owner to educate yourself. Because the reason why the bond market is so powerful is each and every day it's giving you an assessment, not just of where interest rates are likely to be next week, next month, but a year out, 3 years out, 10 years out, 30 years out. And the difference between long-term rates and short-term interest rates is a very powerful indicator of the future economic environment. When long-term interest rates are higher than short-term interest rates, that is the bond market telling you that short-term interest rates are likely to rise because economic growth is likely to be very strong and inflation will be rising. When the yield curve flattens or inverts so that long-term rates are below short-term rates, that is the bond market telling you that we are set for a period of economic weakness, perhaps even a recession, and short-term interest rates are going to have to decline in order to stimulate the economy. There has not been a recession in our country over the last 50 years without the yield curve inverting first 12 to 18 months out. And so in conjunction with the stock market, if the stock market falls in price by a significant amount over an extended period of time, what we call a bear market, a 20% correction for 3 months, let's say, And that is followed by a flattening to inverted yield curve, or is accompanied by it. Those are the first two shoes that typically drop before you need to anticipate, plan for, and take advantage of a potential downturn. The third element is the credit market. And this is a very good proxy for CEO and CFO optimism. You know, business investment in the past has been as much as a quarter of our GDP. For the 10 years, 2010 to 2019, actually business investment was relatively anemic. In fact, the prior administration's Tax Cuts and Jobs Act was explicitly designed to unleash business sentiment, to encourage CEOs and CFOs to invest in the future through capital expenditures and to take the risk to create jobs. And so the ability of corporations to finance themselves in the corporate bond markets by floating bonds is the third key indicator to keep an eye on, because historically, in aggregate, if you look across the entire corporate sector, the ability of their ability to finance activities means that they've had to charge an interest rate of around 5% above treasury bonds. And when that spread between the corporate bond rate and the treasury bond rate has been tighter than 5%, that is corporate bond investors telling you that the future economic environment is likely to be bright, defaults are likely to be low. And vice versa, when it starts to creep up over 5%, that is the corporate bond market telling you that a period of economic weakness is ahead and that distress may be coming. And so, Joe, this is where I wanted to stop and compliment you again. You know, you and I have talked over the years about how important it is to bring an identity to small and medium business owners like us in Vistage. So much of these indicators are about big business. And so I have found your CEO Vistage Confidence Index really giving a sense of where these spreads should be in small to medium businesses very, very helpful. And I hope you will continue to bring the voice of reason to bear for policymakers to consider. So much in Washington, D.C. is about big business as opposed to the small to medium-sized businesses who take all the risk to create jobs. The last indicator is the commodity market. And this gives us a real-time temperature check on the health of the global economy. You'll see in a moment or two what an important theme commodity inflation over the next 12 to 18 months is likely to be. I've used this quote before, but to give you a sense of just how important the emerging world, countries such as China, Russia, India, Brazil, and so forth, have become to the global economy. In the years 2010 to 2013, China actually poured more cement than the United States did throughout the 20th century, which shows you how they have become the marginal producer and consumer of all commodities that are used in the production of things. And so it's very, very important for us, even though many of us don't do business abroad, to keep one eye on the health of the global economy, particularly in the context of a theme that I'm going to highlight in a minute or two, and that is the strategic relationship between China and the United States, which many have now described as the dawn of a new Cold War. And so the Chinese economy and its health is integral to the future. And so those are the four indicators, and a quick reminder as to why they are so powerful on a 12 to 18 month view. They give us a steer on corporate profitability. They give us a steer on future interest rates. They give us a steer on corporate optimism, and they give us a steer on the global economy. So let's take a quick look at each one in turn before we turn our attention to some of these themes that have really been accelerated by the COVID pandemic. And let's start with the stock market. This chart here traces the stock market in dark blue for the United States all the way back to 2009, and for international stocks in red all the way back to 2009. And what you should notice about the stock market prior to the pandemic recession, which officially started in February 2020, that gray bar, and henceforth in all my slides, gray bars denote periods of recession. It's just how smooth that ride has been. You know, there were many reasons to be concerned about the outlook over the last 10 years. Think about the credit downgrade and the European debt crisis in 2012, 2013. Think about the oil price collapse in the early part of 2016. This indicator kept you in the game because it kept telling you that those were concerning moments, but corporate profitability was likely to continue to grow in the future. Of course, in the months of March, the stock market fell by 35% overnight. And so by that magnitude, could be described as a bear market, but it didn't do it in a sustained way. And the reason for that, and the reason why it resumed its ascent so quickly, as we talked about with Joe in July last year, this is 2020 zoomed in, the S&P in dark blue, international stocks in light blue, is really for two really important reasons. First of all, well, really for three reasons. First of all, the stock market took the view that we would find a medical solution to the problem and be able to distribute and adopt it more quickly than people feared. And the stock market, as in many cases, got that right. The second part of reopening the economy sooner so that profits would resume is the extraordinary stimulus that's been applied to the economy in the aftermath, in the immediate aftermath of the Great Lockdown. It's as if authorities learned from their mistake in 2008 and 2009, where history shows that the fiscal and monetary response to the great financial crisis was too little, too late, and in a very incoherent way, which is part of the reason why in the early part of the last recovery, growth was so anemic for so long. They took the counterpoint. And this has been a bipartisan effort. This has been both the Republican and the Democratic Party. They took a let's go big or go home stance to resuscitating the economy, to bring relief to it during the lockdown, making a bet that it was important to grow the economy quickly in order to make sure that we could recoup the lost activity and recreate jobs as quickly as possible. Of course, the corner around the corner is what does that mean for all the debt that we have built up and how does it pay for itself? And I will address that in a moment or two. But that's really been the second part of why investors have thought profits are going to grow so quickly. A third element, and this is a really important story, is the theme of tech acceleration, where the COVID pandemic, and I know, Joe, you've written about this in several of your blogs. I enjoy reading those as well. The way in which corporations across the United States have accelerated the adoption of game-changing technologies has really unleashed powerful productivity gains. And here I'm talking not just about our ability to communicate virtually, I'm talking about automation, I'm talking about the digitization of the payment system, I'm talking about the blockchain protocol underlying cryptocurrency. Really allowing businesses to do more with less and to grow their profitability. And so the sum combination of those three factors, a reopening economy, enormous fiscal and monetary policy stimulus, along with productivity growth, has really allowed the stock market to continue to signal a pretty bright future for us as it continues to hit record-setting highs today. Beneath the stock market, there is a really important story unfolding for those of you that are closer to the stock market that is worth bearing in mind. For a long period of time, indeed for most of the last decade, but particularly over the last 3 years, so-called growth stocks, so stocks with their ability to grow top and bottom line earnings in a reliable way, have vastly outperformed cheaper, more cyclical areas of the market, what professional investors call value sectors. Value sectors are typically in the consumer discretionary arena, industrials, energy, and financials. Since the beginning of the year, value has started to outperform growth in a more sustained way as the market has really started to anticipate that the economy is going to reopen sooner than many anticipate. As the market in recent weeks has started to wrestle with some of the implications of raising taxes next year, you've seen that outperformance of value versus growth start to dissipate again as stock market investors are starting to think around the corner, which is if these tax increases are too much too soon, it could really destabilize a very strong period of economic growth that we are enjoying. Let's turn our attention to the bond market. Here's the slope of the yield curve, and this chart makes the point with those red circles. 12 to 18 months prior to every recession that we've had over the last 5 decades, this chart only goes back to 1986, you know, that yield curve inverts first. And so you can see in 2019 how close we came to that yield curve inverting. Remember that chart right at the outset when I show you the first quarter of 2019, the bond market had moved to a yellow indicator. That's not because the bond market was smart enough to predict a pandemic would cause a recession in 2020. That was the bond market at that time getting concerned about those two things I said at the outset, which was the tariff war accelerating in a way that could destabilize economic growth and monetary policy being tightened too quickly, too soon. So it is worth bearing that indicator in mind. Just take a look at how dramatically that yield curve has steepened. I remember talking to Joe in July last year that the yield curve had already turned the corner after what the Federal Reserve had announced in terms of their effort to bring stimulus to the economy. Since Joe and I have spoken, we've actually experienced one of the quickest and most dramatic rises in long-term rates in the history of capital markets. That yield curve today is as steep as it was in 2018. And I'm going to touch on the extraordinary monetary policy response in one of the key themes because it really sets up the discussion about the potential for future inflation. Long-term rates have gone up dramatically because the bond market has started to assess the potential for an inflation scare in the next few months as the economy continues to grow robustly. You know, the Federal Reserve didn't just apply extraordinary monetary policy through its promises to keep interest rates at the short end of the curve low for a long period of time, and not just because they decided to expand their balance sheets to buy bonds in order to steepen that yield curve again. They took the unprecedented step in March last year. I remember the Sunday afternoon after Great Lockdown when Chairman Jay Powell said, we are going to buy assets in unlimited quantity. And so that was Jay Powell saying, we understand the importance of that third indicator, the credit spreads. Take a look at how credit spreads, remember, corporate bonds over treasury bonds, the ability of corporations to finance themselves cheaply really blew out during those weeks leading into March and the lockdown. And what Chairman Jay Powell said is we're not just going to use our balance sheet to buy treasury bonds. We're actually going to backstop municipal bond markets to make sure that state and local governments didn't experience distress. And we're even going to buy corporate bonds. Take a look at just how dramatically those credit spreads have narrowed all the way back down most recently to under 5%. I've traced the energy sector in dark blue here. Pay attention to the light blue line. You can see how that's dipped below 5%, which is normally dark green territory from this indicator about the 12 to 18 months future economic environment. I'm going to show you a chart of the size and composition of the Federal Reserve's balance sheet, which is really, really eye-opening in a moment or two. And then the last indicator I'd like to touch on is the commodity market. And so here I draw a distinction between precious metals in light blue and industrial metals in dark blue. The industrial metals are the commodity indexes that I encourage you to pay attention to. Precious metals behave more like currencies. What we're looking for here are commodities that are used in the production and consumption of things. And so a great candidate for this would be the copper price, which has actually become known as Dr. Copper for its forecasting prowess of the global economy, but also commodities such as nickel, iron ore, zinc, and so forth. I want to show you a chart in a moment or two about how important commodity markets are as we transition to a world of greater electrification, which is perhaps counterintuitive. But what I want you to notice from this slide is how quickly the commodity market started to recover, even as the recession unfolded in dark blue. And so, of course, China led us into the pandemic and led us out of the pandemic. Many economies like China in the emerging world are more manufacturing based and less services oriented. And so they have been able to be a little bit more resilient as we've had to deal with several surges in the virus and had to go back to lockdown. But it is worth bearing this indicator in mind as the strategic relationship between the United States and China resets in the next 2 to 3 years. China has become a very, very important component of the global economy, and its ability to continue to grow will obviously create an important ability for us to continue to grow here in the United States. So the bottom line is these indicators today are flashing dark green. And as I said at the outset of the webinar, the next 3 to 6 months could be the best period of economic growth we enjoy for a generation. And so that should create a pretty favorable backdrop for us as business owners to do things in our businesses to grow the top and bottom line. In fact, many estimates are for nominal GDP to expand by 10% in this calendar year. Real growth of around 7 to 8%. And if you layer inflation of 2 to 3%, slightly higher than average, you get to a nominal GDP growth figure of around 10% for 2021, which is truly extraordinary. Not since 1983, as I said a moment ago, has there been such bright sunshine for us as we look ahead 12 to 18 months out. That backdrop is leading stock market investors to think of corporate profits growing by as much as 25% this year and another double-digit gain in 2022. A lot depends on the tax increases that I'm going to discuss in a moment or two, but even taking into account the potential for tax increases for corporate profits to continue to grow in 2022. The bond market is today evidenced by a very steep yield curve as it handicaps strong period of economic growth and greater inflation. Credit spreads are tight, easy for corporations to float corporate bonds and to finance their activities. And commodity markets have been on a tear, signaling the health of the Chinese and emerging world. So, as I said, if you'd like to dig deeper into the methodology, the resource I'd flag out here for you is our recessions, red lights flashing. You can get that at both the Insights tab on our website, as well as that dedicated page for Vistage members as well. So, as I heard somebody say in Naples, Florida earlier this week when I spoke to Mr. Group down there, boy, Adrian, that made me feel better. After reading the news and headlines, I felt particularly bleak about the outlook. But the key thing about these capital market indicators is that they're unemotional and that they are forward-looking. And we've used these for 3 decades, not just to navigate the way in which we've invested for clients, but also to give a good sense of where the economy is likely to be over a useful planning horizon. Let me call out some of the key themes that these indicators are really wrestling with today. In the early part of 2019, it really was all about the trade war, and it was all about monetary policy. Today, there are several key themes that really were percolating before the pandemic put us into lockdown, but have become the keen sense of focus today. And I'm going to show you a few charts on each of these key themes. Obviously, as I said earlier on, within the stock market, the rotation from growth stocks outperforming or leading the market higher to value stocks is really a sign that the stock market is telling us that we are on a path to immunity that may come sooner than many of the media would lead us to believe. And so, yes, we developed the vaccination at warp speed. And yes, we struggled logistically to get that out, to distribute it, and to get it adopted in the early part of this year. But we have made substantial progress since then. The second key theme is this perma-stimulus approach that Treasury and the Federal Reserve, and again, this has been a bipartisan issue at least until now, has taken to bringing relief to the economy. Believe it or not, even after the $1.9 trillion additional stimulus package was passed a month or two ago, we're now talking about another $3 to $4 trillion of spending focused on infrastructure, perhaps as a way to help us recreate some of the jobs that have been permanently lost as a result of the pandemic. Thirdly, there's an enormous pent-up demand for services, especially from spring of this year onwards, particularly as the economy unfolds. And Joe, I know you've written a little bit about this as well. Rising inflation expectations, long-term interest rates, and a declining dollar. Absolutely key. With all this stimulus that's been applied to the economy, with the approach of financing that stimulus deficits, coupled with a promise from the Federal Reserve to keep its stance as easy as possible for a long period of time, and doubling down on their promise to not stop until they've created inflation, leads me to conclude that for the business owner, getting used to a period of above average inflation is going to be a part of our lives over the next year or two. And this has profound consequences for the way in which you think about pricing strategies for your business. How do you get ahead of incipient inflation that is percolating from supply chain bottlenecks, all this easy money, too much money chasing too few goods, so that you can protect margins by raising prices on your customers in a preemptive way? Another key theme is this productivity growth from tech acceleration. There are two countervailing forces around inflation that markets are wrestling with. The one is the tendency for inflation to rise for the reasons that I cited: stimulus, supply chain bottlenecks. On the other hand, how much productivity growth has been unleashed by some of these game-changing technologies, which will help to keep a lid on inflation, in particular wage inflation, because businesses are able to do more with fewer people. A key theme that has really been accelerated by this pandemic is debt, demographics, and currency debasement. And here I will call out my Vistage colleagues, Alan and Brian Bolio at ITR. Joe, I know you had them just a few weeks ago to share their update with the Vistage network, but they have been particularly consistent in their forecast that in 2030, all the chickens are going to come home to roost, and all the debt that we had built up is going to become a serious issue because of the demographic tide that is changing, with so many baby boomers retiring at an accelerating rate over the next few years, so taxing the entitlement programs of Social Security, Medicare, and Medicaid at a larger rate. It is my contention that that question has been brought forward by 5 to 6 years, not from 2030. I believe it's going to be the #1 issue of the next election cycle in 2024. And we could see how even next year's midterms could be a situation where serious questions are going to be asked by how we are going to put debt on a more sustainable trajectory. Because this is going to be the first year that the stock of total public debt actually exceeds the size of our economy as a result of all of the enormous stimulus that was applied over the last year. I've received a lot of questions of cryptocurrency. Not a day goes by without a headline around Bitcoin. And I'm going to show you a chart in a moment or two about how the COVID pandemic has accelerated the rise of cryptocurrency and whether that will become a permanent feature of our life post-pandemic. And then I've already touched on the key US-China strategic relationship, which is going to be so key to the outlook as well. Incidentally, over the last few months, we've done a lot of webinars with subject matter experts, not just in the area of wealth management and investments that we focus on at Balentine, to discuss many of these themes. At the Vistage webpage, you can download those podcasts if you wanted to double click on any of these themes and think about it in greater detail. But let's start with a chart on path to immunity. And I want to call out here the National Center for Health Statistics and CDC.gov. It's a very interesting chart which traces the economy's acceleration towards herd immunity in orange. And you can see there how this path to immunity is the sum total of people who have already had COVID and so have the antibodies. Layered on top of that is the CDC estimated additional US infections. But notice in green how we are really accelerating the distribution and adoption of vaccinations. Who would have thought back in July, Joe, when we last spoke, that we would have 2 effective, 3 perhaps very effective vaccinations against COVID-19 widely available? By some estimates, in early May, we would have had about 70% of our total population immune to COVID-19. Of course, there is talk of us having to continue to vaccinate, perhaps a 3rd time in order for us to retain this immunity. But the bottom line is what the epidemiologists and scientists have been able to accomplish is nothing short of extraordinary. The second theme of permanent stimulus is really highlighted by this particular slide. And I wanted to show you this for several reasons. Firstly, the attitude towards providing a go big or go home fiscal stimulus has really been a bipartisan affair, at least until now. In 2020, we passed 5 separate pieces of legislation, of which the CARES Act and the Payroll Protection Plan in March of April last year, which was so focused on small to medium-sized businesses obviously carried the day. But prior to, President Biden's phase one stimulus earlier this year, we'd already spent over $3 trillion of fiscal stimulus in support of the economy. That's approaching 20% of GDP. And now we are talking about an infrastructure bill of around $3 to $4 trillion. And all of that stimulus is being financed by the Federal Reserve. This is the size of the Federal Reserve's balance sheet going back to 2006 and also traces its composition between US Treasury bonds in dark blue, mortgage-backed securities, and other securities in green. Notice how that balance sheet jumped up in 2020. And notice how the size of the other securities is growing. At the current run rate, the money supply has grown at over 20% for over a year as a result of the Federal Reserve's three-pronged approach in bringing stimulus to bear by financing these fiscal deficits. Firstly, they dropped interest rates to zero, and they have told us that they're not even thinking of raising interest rates, at least not before 2023. Secondly, they've said they're going to use their balance sheet here as their weapon of choice in buying assets in unlimited quantity to make sure that distress from the lockdown does not seep into the economy. And thirdly, way back in August, after we spoke, Joe, they made a very significant change in the way in which they've thought about the future path of interest rates in handling the economy. At Jackson Hole in August, Jay Powell said, you know what? We have been accused of irresponsibly printing money for 10 years in the aftermath of the great financial crisis. And yet our inflation has fallen short of the target that Congress has mandated us of 2%. And so we are going to pivot. We're actually going to let the economy run a little bit hot as it recovers from COVID and tolerate higher than average inflation, bring the average rate of inflation to that 2% target that Congress has demanded for us. And so the Federal Reserve is, we're not going to stop until there is inflation. And so this is a tightrope they're walking, because as this game can work only for as long as we believe that their credibility in fighting future inflation remains intact. But the bottom line is, as a business owner, get ready for higher than average inflation over the coming months. I wanted to call out an additional resource for you, which I found very, very helpful as a business owner, as well as somebody who's thinking about preserving wealth on behalf of my clients during this pandemic. And this is a new resource called tracktherecovery.com. You can see that on the top right-hand side of this particular slide. And this is a collaboration between the Gates Foundation and Harvard and Brown universities to take private sector real-time data to give you a much better sense of where the economy is at today than the official lagging government statistics might suggest. It's really very interesting. If you click on that website, you can look at the economy on various different dimensions. You can look at how the regional economy is performing all the way down into the city in which you're conducting business. But I pulled out here the percentage change in consumer spending going all the way back to January of 2020. And I've shown you how consumer spending has changed between low-income earners and high-income earners. And notice just how much low-income earners have spent over the last year. Of course, a lot of that had to do with stimulus, and a lot of that has to do with unintended consequences of people not coming back to work as soon as they might otherwise because of stimulus checks. But notice how anemic high-income spending has been. It's only risen around 4% since the peak period of the pandemic. That leads me to conclude that there is enormous pent-up demand for services as the economy reopens, which is likely to provide a powerful tailwind to the economy in the next 3 to 6 months. Inflation expectations have already risen. If you compare inflation index bonds to nominal bonds in dark blue, or what we call in our industry the inflation break-even rate, you'll see on the left-hand axis that inflation expectations 10 years out have actually risen quite dramatically since the dark days of the lockdown, where it bottomed out at around 60 basis points, so roughly half of 1%, all the way up to 2.2% just recently. And you'll see how correspondingly that has put pressure on the dollar to decline. And so this helps to underscore the theme of how bond markets are already beginning to anticipate higher than average periods of inflation. And an inflation consideration that is particularly important to bear in mind is commodity inflation. And so I wanted to call out this particular slide, which I first saw in Barron's in February, but it's a particularly interesting slide to show the point that as we continue to talk about infrastructure being a way to create more jobs, to provide additional stimulus to the economy, and really try to create incentives for our economy to be more electrified than relying on traditional carbon fossil fuels. Take a look at this particular chart, which shows what metals are needed to build 20 million cars by Tesla. And you'll see on the left-hand side, all the way from graphite through to aluminum, what material is required to build 20 million electric cars. And that's compared to the actual production of those commodities in 2019. And just take a look at the percentage of production that that material required makes up. It's counterintuitive. As we move towards greater electrification of cars, we are going to demand higher and higher commodities. There is more copper wiring in a Tesla car than in my traditional car, and many people don't appreciate that. And that's another reason why commodity inflation is such an important theme to bear in mind. Debt and deficits. I'm afraid we have to go all the way back to World War II to see deficits run up as quickly as we did in 2020 as a response to the pandemic. As I said, it's literally been a wartime-like response of go big or go home. You'll notice that that deficit is actually projected in 2022 to decline quite significantly. And a lot of that has to do with the anticipation that this administration is going to pass one of the largest tax increases across the board next year in order for us to start to eat some of the spinach after all the candy that has been handed out so far. And so one of the things I implore you all to do, in as much as you all need to take into account higher inflation and think about your pricing strategy, is revisit your financial plan right now, because taxes are likely to go up across the board. And this slide highlights some of the proposals that are still being talked about and firmed up. And it is my view that because tax changes have to pass by a process of reconciliation, that means that the House and the Senate have to successively reconcile what has been proposed. That in turn means that some of the more extreme measures will be watered down, in my view, in a final bill. But get used to the fact that what's at stake next year is a rise in the top marginal income tax rate, a lower amount of the tax deductions, is particularly for high income taxpayers. Critically, and Joe and I have been talking about this in the prelude to this webinar, there's a significant chance that capital gains tax rates and dividend tax rates go up from today's 20% to 25 to 28%. I don't believe the more extreme measures of 40% will pass. That is because the Bipartisan Committee for Tax has actually shown that when capital gains exceeds 28%, the amount of revenue that the government is able to collect actually declines. And so it becomes counterproductive from the point of view of broadening out the tax base. There's even talks of an unrealized capital gains tax. I'm not sure that that's likely to happen, but very critically for those of us who have spent a lifetime building a business and want to pass that business on perhaps to other family members or even sell it to other prospective buyers, estate tax changes are likely to be significantly changed next year. Today, we have extraordinarily generous unified credit exemptions, around $11 million per person. That allows a married couple to pass on, $22 million of their net worth to the next generation without having to pay estate tax. If they are to lower those deductions from 11 back down to 5 or even 3, and they raise the estate tax from 40 to 45, and they stop the step up in basis, which means that folks that inherit assets actually don't get their basis reset, that could be a significant dent to your ability to hit your goals over time. And so I would encourage you all, as one key takeaway from today's presentation, to just take one step back and revisit your financial plan, and to have a conversation with your trust and estate lawyer about what you can do to mitigate some of these tax proposals. And then lastly, for those of us who are doing business in a C corporation, the proposal is to partially repeal the Tax Cuts and Jobs Act of 2017. The legislative math is going to be hard to get it up more than 25%, but that could knock as much as 6% off of corporate earnings expectations in 2022, and could have a significant effect on whether the economic momentum we're experiencing today is likely to continue. Lastly, let's talk about cryptocurrency. And this is a useful way to think about what is a currency or not. There are several characteristics that make up a currency, ranging from its durability through to its portability, divisibility, uniformity, limited supply, and acceptability. And the point I'm trying to make with this slide is the inherent primacy of the US dollar as a currency is only today being challenged by the idea that it has unlimited supply. It checks the boxes on every dimension. Unlike gold, Bitcoin is being increasingly adopted. It's not yet acceptable across a broad range of transactions. It's very helpful for international cross-border transactions, but we're not yet able to transact as effectively for all sorts of things as we are in the US dollar. And frankly, Bitcoin has not proved to be as durable as US dollar or gold. There is talk of, people's Bitcoin wallets being hacked, of Bitcoins not being able to be used over and over again. And so in my view, the jury is a little out. And what I'm very focused on is the underlying protocol here, which is the blockchain technology and what that may mean for future businesses. So I hope some of those key themes are helpful for you to think about. Those are the things that those indicators are really dialed in on. I'm going to end off my talk before opening up for questions by just helping you think through what the implications might be if you drill down all the way into your business from some of these key themes. And I know, Joe, you and your team have written several blogs on these issues. I've mentioned some of that, but I do urge you all to think about the one enduring lesson of the pandemic, which is just how resilient your business model is. Do you have a business model that has recurring revenue? Do you have a business model that is able to continue uninterrupted when an economy goes into lockdown? What can you do to increase the resiliency of your business model, not just in terms of your financial strength, but the way in which you charge customers? The agility of decision-making. I think history shows that the winners from the pandemic were those that were able to be nimble, those that were able to pivot quickly, as opposed to being bogged down in a bureaucratic governance structure. We've tackled the topic of supply chain management on several occasions. You can listen to a podcast that we've done on that. Many companies I come across within the Vistage network now are running two supply chains, and that's going to be a fact of life going forward. Companies have taken the view that their ability to continue to do business uninterrupted means they have to have a second supply chain just in case. It's no longer necessary to have it just in time at the lowest possible price. And we've talked about taxeleration. I've thought very deeply about this issue and how it affects my own company in the wealth management industry. And I've noticed how we've been able to adopt technology more quickly to be more efficient at certain things that we used to be. Our customers have all started to change their buying behaviors. It's remarkable to me that I've been able to expand our client base far across the United States through people being more comfortable to meet virtually. Digital marketing strategies are so important in capitalizing on the new way in which we are able to communicate. I call you all's attention to Joe's most recent blog on workforce engagement. Such a key issue as the economy continues to grow and perhaps experience labor shortages in certain industries. Your ability to attract and retain talent, not just based on competing on price, but paying a salary, by emphasizing things such as your culture, things such as your approach to flexible time. As we have grown through the pandemic and added staff, our approach to flexible time has become one of the number one questions prospective employees have asked us. I think about reimagining the workplace with new technology for my own business, and how much space you truly need to have to gather to do business. And as I've always said, during strong periods of economic growth like we're able to, lucky enough to face in the next few months, always start to think about the corner around the corner. The best time to impart greater resiliency to your business, to prepare for the next downturn, is when times are good. Now is the time to make sure that your credit lines are where they need to be. Now is the time to reinforce your relationship with your banker so that you know the next time there is a downturn, your ability to finance activities is not called into question like it might have been in March of last year. And then I'll end off with this so important point. Your ability to talk to your clients and customers about your value add so that you are able to raise your prices. And by the way, there's plenty of aerial cover today with rising general inflation to raise your prices so that you can protect your margins and profitability ahead of general inflation picking up, especially if inputs to your business are in the commodity areas, is so important. And so, what I encourage you all to do within the Vistage network is to visit the Vistage website. There are some great speakers on some of these topics, just to mention a few. Ark Rosenthal on digital marketing, who tells you to think about your website as your number one employee, give it an annual review. He's worth listening to. Culture, David Friedman, and fundamentals. I've applied his message to my own business, and I've seen how we've been able to turn culture into one of the most important strategic assets that we have. Casey Brown on pricing strategy. David Hooley on technology and how that's likely to disrupt the next decade. All of those are speakers that have really informed my thinking on how the future economic environment is likely to affect my business on these dimensions. So I'm going to end there, Joe, but before I hand it over to you to perhaps answer some questions, I do want to draw your attention to Balentine's investing Cardinals. This was partly in homage to the Vistage legend known as Red Scott. He had those pithy business Cardinals, which I know a lot of Vistage members have become familiar with. My favorite one is his first one: don't run out of cash no matter what. The second one is no surprises, give me fair warning. I've really, in that vein, authored during the lockdown some enduring Cardinals that we have learned over 3 decades of navigating capital markets, which you can download on the website. And we've attached several readings for you each to read around the topics at your convenience. And then lastly, I will say that we have received a lot of interest about the book that Robert and I have authored. It's going to be published here in May, and it's called First Generation Wealth. And this is really not a self-help book. It's really a book to encourage business owners and entrepreneurs to think about some of the questions that we've encountered over the last 30 years of advising business owners about the stuff that really matters. Wealth doesn't always come from just having a lot of money. There is so much more to it. Understanding legacy, understanding your purpose, separating out the business of the family from the family business, helping to prepare the next generation and seeing the world through their eyes when they're ready to have conversations around wealth management and the business is so important to bringing resiliency to your family in addition to your business, so that you can avoid going from shirt sleeves to shirt sleeves in 3 generations, as so many family businesses unfortunately do. And you can register for that on our website as well. So I hope that has been helpful. Joe, I'm not sure what sort of questions we've had.
Well, Adrian, thank you so much. We have got a world of questions, the majority of them coming from me. I certainly enjoyed your presentation and all the ideas you gave me. And I want to try to synthesize them into a couple questions, see if we can get some traction. One, you commented the next 3 to 6 months and really 2021 is going to see historical levels of growth. But when does this party end? At some point, inflation kicks in. At some point, interest rates come up. Do we see, if you look beyond that 9 to 12 month horizon, what do you see beyond that? Are we talking 2 years, 3 years, 5 years?
Yeah, so I appreciate that question, and it helps me to reinforce the key point today. Watch those four indicators: the stock, bond, credit, and the commodity market. Those are going to tell you 12 to 18 months out when this party is going to end, right? And so when you start to see volatility in the stock market, not normal corrections of 10 to 12%, but something approaching a sustained bear market, and you start to see the yield curve flatten or invert, and you see credit spreads starting to blow out, and you see commodity markets rolling over, that'll be your leading indicator as to when the party is going to end. As I said, and it wasn't clear from the charts today, but if you really look over the last couple of weeks, those indicators are starting to assess very carefully what are the chances of a combination of inflation and tax increases leading to a mistake, so that in 2022, this period of economic growth may actually come to an end. And you've seen the stock market be a little bit more volatile. You've seen the rate at which long-term rates have gone up, started to stall. The yield curve hasn't steepened. Credit spreads have remained contained, and commodity markets have remained contained. But should markets come to the conclusion that tax increases across the board is going to be too much and is actually going to destabilize economic growth, or inflation is going to run so much harder than the Federal Reserve anticipates that they're going to be forced to raise interest rates more soon than they have signaled, that could be a situation where those indicators move from green to yellow to red, and when the party is going to come to an end, and hopefully you're ahead of it. I mean, that's why I try to give this talk to business owners. If you're ahead of it, you're able to turn the party that's going to end into an opportunity to profit from other people's distress as opposed to just a risk mitigation exercise.
Adrian, when that party does end, is that going to be a slowing as people slowly leave? Or are we going to turn the lights on and all of a sudden party's over, go home?
Yeah, well, the lights go off sometimes for unforeseen events, right? The pandemic is a great example. 9/11 is another example. The stock market crash of 1987 is another example. That's why I preach the importance of building resiliency into everything you do. Having a resilient business model, being resilient when you're investing, making sure that you have enough financing in your business and enough cash in your portfolio to sustain activity and spending needs for 2 years at any point in time, net of portfolio yield, so that when the lights go out suddenly, you're not reacting and making bad decisions, selling assets at artificially depressed prices when investing, or not being able to invest and hire people from your competitor who might be suffering distress. So that's important, I think, for thinking about when the lights go off. Always have resiliency in your business, your portfolio, in your family when the lights go off. If there is a slow rollover, these indicators should give you plenty of time to course correct around your strategic plan, because it normally takes 12 to 18 months to unfold.
Adrian, thank you for that. I literally have a full page of questions to ask, but we've gone over the time. So I want to say thank you very much for your time. We'll look to get you come back and visit us again in the fall and kind of see where we are as we start to zero in and focus on what 2022 and beyond are going to be. But you've certainly been very...
I appreciate that, Joe. I think we'll have a lot more visibility around taxes and inflation, today's themes at that point. And of course, I encourage anybody to contact us anytime if I can be helpful between now and then, and just keep up the great work. I really applaud the way you've been able to give an identity to us as Vistage business owners and attracted the attention of both media and hopefully policymakers to make sense of it for us. Not just big corporations. So I appreciate your time very much today.
Great. Thank you very much, Adrian. And I look forward to your newsletters and the resources you have for Vistage members. We greatly appreciate that. So with that, I'll say thank you again for your insights. A note, all attendees, you'll receive a link to the recording and slides within the next 24 hours or so. We'll also send you some details about 3 upcoming events. On May 7th, we have a webinar on ESOPs and impact on employee engagement, corporate culture. And oh, by the way, it's huge for retention. It's a big issue now. On May 14th, I'm really excited. We've got 3 of our best speakers on marketing who are going to talk about marketing in a post-COVID marketplace. Everything has changed. It's a whole new reality. And these 3 folks are going to give us some really powerful insights. And on May 21, you're going to want to make sure you register for our 2nd National CEO Conference of the year, this time on fiscal health, where we'll have some of the very best speakers coming in and talking about the things we need to do. If we learned one lesson, and if you go back to where you were a year ago, if you were tight on your fiscal planning and you had your numbers in a row, you fared better than if you were trying to figure it out on the fly. So with that, I'd like to say thank you, everyone, for your time and attention today. Again, thank you again to Adrian Cronje and the work from Balentine and the work he does with our groups that he shares with us here. And I wish you all a safe and happy week ahead. And thank you for your time and attention today. Joe Galvin, Vistage Research. Thank you very much and goodbye.